I want to show people that money can be made on the stock market. It's not easy to make money. You have to have a rock solid strategy. You have to take your time. You have to devoid yourself of your ego. You have to establish rules and just go accordingly. So today, the topic is generating monthly income using credit spreads. Okay, what I'm going to be going over, the first thing I'm going to be talking about is results on trading the Russell 2000, the RUT, using not only credit spreads, bull puts, bear calls, but also putting them together for an iron condor where you can get credit for both sides. Then I'm going to be talking about the time value of decay of options. That's how we make our money. We basically, when we are trading credit spreads, it's like you're going into a casino, and who wins in the casino? Yeah, you might win every once in a while, but over the long haul, the house wins. And when you are selling credit spreads, you are putting yourself into that category. Then I'm going to be talking about why I trade this wealth building strategy. Then for some of you that are just new, I'll quickly go over what a bull put and a bear call is. Not all credit spreads are created equal. And I'm going to be talking about the ones that I trade, the ones that are really worthwhile trading. What are my indicators that I use? I use the same indicators for everything I do, whether it's trading stocks, trading options. The indicators that I use are very powerful, and it's really three that I use. Regression channel, talk about Fibonacci's and measured moves, although I'm not going to go into a lot of that today. And the last one is the macro MACD. This is an indicator that I developed. It's the daily version of the weekly MACD. If you need more information on these, you can just go to my website, which is www.optionsinfinity.com. Become a free member, and I've got webinars on all those indicators and how to use those, how to set them up on your trading platform, and what's the best way to look at them for finding out the best trades to not only get into, but to get out of. Then we're going to talk about the trading rules. The trading rules are so important. And then we'll go over 3 actual trades. 60% return on a bull put on Google. 108% return on a bear call on Amazon. 100% return on a bull put on the SPX. Then we're going to go over to my website, and I'm going to show you how you can become a free member and what else I've got available to you. Okay, as Renee said, again, excuse me, my name is Dale Brethauer. I've been trading for 35 plus years. I run my own hedge fund. I've been a keynote speaker for a number of places. I've written 3 financial books, and currently my focus is teaching people what I have learned over 35 years. And that is done via my website, which is www.optionsinfinity.com. I want to just go over some of the credit spread history using the RUT. Not only use bear calls, bull puts, but iron condors on the RUT. The RUT theta trade, I call it a theta trade because you're looking for the rapid decay over time of theta. Since this year, we've had 88% per month. with 88% winners, 7 out of 8. It's been a very good year. You say, well, okay, how about last year? Well, last year we had a 92% per month with 75% winners. Say, okay, well, that's good. Here's one more data point. I had one of my mentees loved what we were doing here, and he went back and back tested this strategy using the rules that I had set up for everybody. And over a 10-year period, he came up with 79% winners. 79% winners. And that's over a 10-year period. And that's not me. That's not me. That's one of my mentees. That's an independent study. So I put a lot of credence into that. But look at this. This is such an awesome number. You say, nah, that can't be real. Oh, yeah, it is. Yeah, it is. Yeah, it is. And you're not going to find anywhere out there that can beat that percent. This is a snapshot I took from my Thinkorswim. I'm not affiliated with Thinkorswim. I just happen to believe they're one of the best trading platforms available today. And let me see. I think I have a question here, but let me see if I can get. Okay. Somebody was having trouble logging in. Okay. You can see that way back here I did a bear call. These have been all iron condors. I use the Arun indicator, which shows new highs and new lows over a 25-day period. When they're both heading down, that's a great time to put on an iron condor. And you can see how an iron condor with the bear call and a bull put, you've got things bracketed, and as long as the RUT stays within certain boundaries, and the RUT usually stays within plus or minus 1 standard deviation of the mean. And you can see most of these trades, the bear call and bull put, are considerably out of the way. This last one, it came down. I chose to get out here because you don't know what tomorrow is going to bring, and it happened to come back, and everything would have been fine. But I'm more of a conservative type trader, and I thought it was wise to exit that. Here's the independent back testing for 10 years, and you can see the win per month. Now, you're not going to win every month, okay? And you've got to manage your money, okay? You can't put everything on one trade, because when you do, one, you're going to have so much anxiety, you're not going to be able to think correctly and stay with the trade and manage it accordingly. And two, that just could be the one time, the two, could be a string of 2 or 3 losers. And that's when you're going to get hit, and you're going to say, oh, this doesn't work. Well, yeah, it does. If you manage your money correctly and stay with it, it works exceedingly well. Now, this is just a chart showing the rapid decay of theta based on time, especially during these last 30 days of trading. You can see it goes down, it goes down, it goes down, but this is exponential. This is an exponential drop. And we, setting up a credit spread, we are sellers. We are sellers of premium. Therefore, this rapid time decay is working in our favor. That's a big edge. That's a big edge. Why I trade it this way. One, you get great returns. And it's coupled with a probability that the price will stay within a certain range. it yields monthly income on a consistent basis. Yeah, you might have a month or two down, but that's okay. That's okay. You got to stay with it. You got to stay with it and just keep on doing it. You have a high probability of success in this because we're selling premium. So time with buying and selling options, I mean, yeah, you can hit home runs, you can make a lot of money, but you have to be exactly right, and you have to be hit it right on the nose as far as the timing's concerned. Time is in our favor when we sell premiums. Time is money. The biggest thing I think on credit spreads is you don't have to constantly watch the market. A lot of people work for a living, are still actively employed, and they can't chart hawk. And if you chart hawk, if you learn anything, don't chart hawk. I do not chart hawk. I actually was trading, day trading for quite a while and doing very well. And but I said to myself, what are you doing? What, you know, at the end of the day, did you help people? Did you do the things you wanted to do? Did you have time to spend on yourself? Did you? No, I was watching bars go up and down. It wasn't very satisfying. So that's why I love the credit spreads. They're low anxiety. And because you do a credit spread, you're selling premium, but you're buying one further out of the money to protect you against catastrophic losses. Okay, quickly, a bull put. A bull put basically is what you, at the point you enter a bull put, you're thinking that you're bullish. Therefore, the operative word here is bull put. What you're doing is you're selling a put quite a bit out of the money, and then you're buying one further out of the money. Okay, and a lot of people say, well, why don't I just sell this naked and watch it go to zero? Well, you know, you can. You got to have a lot of margin. The brokerage houses know that that's a very, very risky operation, and they will require you to have a lot of margin in your account. Well, if you look on return on margin, you actually do better using a credit spread because you're required a lot less margin. And when you look at the returns you get, yeah, you're not getting the $20, you're only getting $2, but that's $2 on a lot less margin requirement. So the return on capital invested is actually higher with credit spreads. Now, the nice thing about credit spreads is you can win if you are correct as far as it being bullish. You can win if you're not necessarily correct, but the price goes sideways. Let's see. Let me just quickly go back and show you the slides I was talking about. You don't need to see me, but here was the stats on the RUT. 88% winners this year, 75% last year, and in this 10-year period, 79. This was the actual trade. You can see, you know, within plus or minus one standard deviation. And here's the independent back testing. And the other thing is, as Renee mentioned earlier, this is going to be loaded on YouTube, and since I'm the first speaker, you'll be able to go there and pick me up real quick. Here's the rapid decay of theta with options, and why I trade wealth building system. Big thing is low anxiety, protection against losses. And we were right here on the bull put. Okay, and I was saying that it is a bullish strategy, so you can win if it's going up. You can win if it's going sideways. You can win if you are wrong and it's going down. Okay, and that's the beauty of this strategy. You don't have to have it right, and the time is in your favor. Now, the bear call is just the opposite. In the bear call, what you're doing is, rather than putting on selling a put, what you're doing is selling a call and buying one further out of the money. Okay, and buying one further out of the money saves you against a catastrophic loss. You get less credit, but like I said, you're not required as much margin, so the return on capital invested is a lot better. However, not all stocks are created equal as far as setting up credit spreads. What I've done here is I just went back and I said, okay, what would a bull put spread look like 41 days from expiration with a delta of 0.1 and with a 10-point spread, just so I could see the difference between stocks that trade around $1,000 and stocks that trade around $50 to $100. And you can see the difference in the premium you can capture by going with the big boys. I call these the big five: Amazon, Google, Priceline, RUT, and SPX. And you say, well, why can't I just buy 10 DuPonts? Yeah, you could buy 10 DuPonts, you could buy 5 DuPonts and get you the same credit. However, you've got 5 times the commission to get that. Okay, and look here, if you got 19 cents credit, what happens if you don't get filled exactly where you want, and that slips down to 17 cents, and then you got commission on top of that, and all of a sudden you're down to 12 cents. The returns evaporate very quickly when you're working with that low of credit versus these big boys. Focus on these big boys. Focus on these big boys. That's where you're going to get the consistent returns. Now, what are the indicators I use? Let me just see if there's any questions. My question thing is okay, good. Okay. Okay, somebody wanted to see the delay chart again. I can surely go back there and show you that. Okay, and here you can see that the premium. Yep, when an option is made out of two things: intrinsic value and extrinsic value. Okay, and if it's out of the money, you've only got time value in there. All right, and what we're usually doing is selling out of the monies, so the only thing left is time value. And as time erodes, especially in the last 30 days, it exponentially drops off, and that's working towards our advantage. That's a big advantage for us. Okay, let me jump back to where we were. The regression channel is based on, this is the regression line, and it is calculated by 50% of the price being above, 50% of the price being below. And so it's a great trend line. The green lines are plus or minus 1 standard deviation. The gold line is plus or minus 2 standard deviation. I'm going to show you what that means in a second, but a lot of these will not deviate much from the plus or minus 1. Occasionally they'll go over here, and occasionally they'll jump out of the 2. That's an outlier. I mean, you can almost think of this purple line as being a magnet. The more it gets away from that line, the harder it sucks it back, and sometimes it overshoots and it'll bring it back. And I've used the regression channel. I used to calculate it by hand. Nowadays it's done automatically, and you get a little, it's so easy to follow that. It's a tremendous tool for overbought and oversold conditions. The other thing I like to use is what I call the macro MACD. This is the daily version. It's a histogram, the daily version of the weekly MACD, and I'm looking for the color change here to show me when it's changing direction. All right. And like I said, you can go on my website and learn a lot more about these 2 indicators plus a lot more. Quickly, here's the MACD explanation. The MACD, of course, is the 12-period exponential moving average minus the 26-period. Then you've got the signal line, which is the 9-period of that. And this histogram measures the distance. Well, when it changes, when it starts constricting, is when I start looking to get in. Okay, so I get a little bit of jump over wait until it crosses, like most people do. And I'm using the daily version of the weekly MACD, which is a lot less fluctuations, if you will. Not, you're not in and out as much. Question on why I use a $10 spread instead of a $5 spread. And that's a good question. You get more credit, first of all, with a $10 spread. You have a little bit more risk. Okay, you have double the risk. You have double the return when you go with a 10-point spread. And for these credit spreads, I'm looking to get in plus, right around 30 days from expiration. So we've got some time if it starts going against us for it to turn around. Whereas for the more shorter term, I use the same strategy on weeklies, and I go with a 5-point spread because sometimes you don't have that time for it to turn around. So I hope that answers your question, Richard. Okay, once again, here's the regression channel. Again, plus or minus 1 standard deviation. That means that about 65% of all prices will be contained within there. Plus or minus 2 is about 99%, 95%. And here's the statistics behind that, if you will. Plus or minus 1 standard deviation is 68.2%. Prices will be contained within that. Then you add on another 26% on the 68, and that gives you about 95% for plus or minus 2. Yeah, occasionally, the stock market doesn't know about statistics, and occasionally you will have outliers, but that presents an opportunity when it reverts back in. Chris says, what platform is that? I use Thinkorswim, Chris. Not affiliated with them, but I think they're a great trading platform, especially for the people that are doing their own trading. Okay, here are the rules. I have 2 charts, and you're going to see these in a second. On the left-hand chart, I look at the 1-year weekly, and I'm looking for the price to be overbought, oversold, and that's based on the regression channel. You're welcome, Chris. Step 2 is I'm looking for a ready change in color of the macro MACD, set a higher high or lower low, and go a continuation. Okay. Step 3 is I always avoid earnings. Right now, I am not trading Amazon and Google because they have earnings coming up October 26th, and that's not enough time between now and then, even if I do get a strong signal, to get in and out. And I never want to hold a position going into earnings, never ever. Don't have to worry about earnings on the RUT and the SPX. Step 4 is I'm going to buy a bear call or a bull put about 30 days until expiration. And there's plenty of options available to allow you to get zero right in on that. But I want to make sure I've got open interest of greater than 100, and that's going to allow me to get a good price. Step 5, of course, is the exit. I always want to know when I get into a trade. I always want to know when I want to exit. And I'm going to exit at a profit of 100%, and for me that's $1, or a loss of 60%, and that's 60 cents. And I use the risk profile for that. Okay, just looking at some of the questions. Okay, here's some actual trades. This first trade is Google. It was August 31st of this year. Got out September 20th on 60%. What we did, that's this trade right here. I saw this move. Okay, it changed color. It had a ready, set, go, and I got in right about here. Okay, actually right close to about 10 o'clock in the morning, right about in here. So I knew that as far as on the left-hand side, it was oversold. It was down around the -1 on the regression channel. So I was looking for it to hold some support and for it to kick up. And when I got the ready, set, go confirmation here, I got in there with a bull put. So you look at that and you say, man, you missed it, Dale. I sure did. It didn't continue going up. It actually went down. And then it kind of held. And then it went down again. And then it went pop, pop, and I got out right there. I got out. And what you do is you buy that back. You buy the bull put back. Sold it for 90 cents, got 30 cents back for a 60% return on a trade that went against me. That's why I love these things. Trade went against me, and I still made money. My question screen is real tiny, so let me see. Okay. Here's one on Amazon. I got in, this was a real quick trade that I got in, and this was a bear call that turned out very nicely for us. Down it went, and when right around in here, I had gained back a lot. It was down around 12 cents, and at that point in time, it had 20 days left till expiration. Well, I'm going to buy it back because I don't want to have that 20-day risk on my hands for just 12 cents. I already made $1, or made $1.80 or $1.08. That's good. So therefore, I want to get out at that point. Okay. And so here's an actual trade that on the SPX, we got in here, right here, with a ready, set, go. It pulled back a little bit, and then it was off to the races. Made 85% on that. Sold the 18 August 2410 put, and bought the 2400 put for $1.05 credit, and bought it back for a nickel. Okay, and because it was so strong, you can see I was pretty close to the 30 days. I think I was like 4 days out from expiration, and at that point in time, I want to just, you know, get out. Okay. Okay, so what I want to do now is I'm going to go over to Thinkorswim for a second and show you some other things. And then I'm going to go to the website, and I want you to see how you can become a free member. What I'd like you to do is, I mean, I've got a myriad of webinars on there. I've got things on the Macro MACD. I've got regression channel. I've got measured moves. I've got Fibonacci's, how you can trade and exit with the Fibonacci's. All these are free, and I really want you to hear from me, see the trades, learn from me, and see if I make sense to you. If I don't make sense to you, that's fine. But I want you to dig in and see if all this stuff makes sense at your leisure. And then if you want to become a member, there's two programs that I have. One is Options Pro, and that's basically what I've been talking to you about. And that's trading credit spreads about 30 days from expiration. This is a wonderful strategy for somebody that doesn't want to spend a lot of time with their trading. The other is the SPX weekly option regression. A lot of the same tools, a little bit faster paced. It's interesting because the return on both of these is about the same. It's about the same. So, and they use the same rules. So, you know, it really is up to you if you want to be a little bit longer. Well, 30 days, consider that a long-term trader? No. But if you want to do that, that's the Option Pro. If you want to do weekly options, it's the SPX. And I'm scheduled to do another Investors Inspiration here the 19th of this month. And on the 19th, I'm going to be talking about the SPX program. So put that on your calendar so that you can you know, hear more about this program, and you can go to the website and learn more. Before we go to the website, let's see. Yeah, Scotty, I do use implied volatility only on the short-term weeklies, and that helps me to determine, because if you use the implied volatility, it's going to actually tell you a plus or minus move, the probability of a plus or minus move within the time period that you have it. And usually for the weekly options, I've got them for, like, you know, 5 days, 7 days, something like that. And I most definitely use the implied volatility on the shorter term trades. I do not use it on the Options Pro trades. It was a good question. Good question. Okay, let me bring over the website. No, let me go to Thinkorswim first. Let's do that. And let me see if I can do that. Okay. Okay. All right. You can see that on my watch list, I've got the big five: Amazon, Google, Priceline, the RUT, and the SPX. Okay. I just want to show you how powerful credit spreads can be. And I just went through, I've got about 7 of these I want to show you real quick. You can see that Amgen here had a pullback almost down to the -1. At that point in time, I'm starting to look for a possible entry. And here's a measured move. A measured move is it's going in the direction, it pulls back, and it makes a new high. All right. The classic definition of upturn is higher highs, higher lows. And that's what a measured move is. It comes up here, it pulls back, it makes a higher low, and then it confirms that with a higher high. That's an uptrend. Okay, you get in there and you see what happened. Okay, Amgen continued on very strongly. All right, let's take a look at Cummins Engine, CMI. Okay, you can see that right down here, it was down to the -1. A lot of support down here. I'm looking for a turnaround. I got a ready, set, go, but then I got a measured move right here. A measured move right here, and whoosh, off to the races it goes. Okay, wonderful setup for a bull put. Wonderful setup. And remember, with a bull put, I mean, if it sits there and stalls for a while, that's cool. But using this technique, they usually shoot right up. Here's something that's oversold. Okay, a measured move right here. Boom, off to the races. Happens time and time again. DHR, Danaher. Oversold. Comes back up, pulls back, makes a measured move, boom, off it goes. Okay. HD, I think, is Home Depot. Let's see, HD. Oversold. Measured move, boom, up it goes. Okay. You're saying, well, these are all good for the market's been strong, blah, blah, blah. These are all good. Well, how about a stock that's going down during the same time? And it does happen. It does happen. Stocks do go counter what the market is going. And here's MDT that made a measured move right there. Wouldn't that be a beautiful bear call up around here? Boom, down it goes. And the last one I want to show you is Procter & Gamble. And here again, you can see that it had a strong move. It came back, it pulled back, and it made a measure move right there, and off it goes. Okay. Stocks do go down indeed, says Oswald. Yes, they do. And the beauty of this is this strategy. When you think the stocks are going to go down based on your indicators, you put in a bear call. So this strategy is good for bull markets, bear markets. By the way, we are in the bull market, and probably will stay in a bull market until the interest rates get up to around 3-4%, because the big money, they don't have any place else to put their money at this point in time. So the bear market, if you think a correction is imminent, no, it's not. It's not. You might have some corrections here and there, but until the interest rates get up around 3 or 4%, you know, it's not going to have. We're not going to see a big correction. Okay, let's get out of Thinkorswim here and bring over my website. And here we go. This is www.optionsinfinity.com. It's what I believe is the very best educational website today. It teaches credit spreads, a little bit longer term and very short term on the weeklies. What you can do is, and I'm a believer that you got to keep it simple. I've got 3 indicators that I watch. I've got 5 stocks that I watch, and therefore I can really focus on those and not worry about all the other minutia that's going on in the market, because there's a lot going out there. The other thing I would suggest y'all do is don't listen to the talking heads. Turn off CNBC. I mean, really. I've heard the same reason given for the market going up as going down. They got to say something, you know. So you can do your own trading, do your own thing. To become a free member, you just click here. You're just going to need your email address. You set up a passcode, and off you go. Here are my 2 programs. Option Pro. Option Pro and SPX War. What you're going to get on both of these is I've got a 4-part course that I teach exactly what I do. You'll get that. You'll see an opening and close position list all the time. When I see a trade, you will get a real-time text and email alert. Text and email alert. One thing I would caution is when I see a trade, I will send this out. I am not a registered investment advisor or a licensed broker. Therefore, it is what I am doing. You have to make the decision whether you want to pull the trigger. Okay. Then at the end of every day, I do a session review that's loaded onto the website about 5 o'clock every day, talking about what happened during the day, how we're managing our trades, how everything's going. Then once a month, I have a live session with me, talking about any questions you've got, going over all our live trades, going over the rules. I'll give you my email address. So you can contact me directly on my direct email. Okay, and everything is recorded and archived. So it's I'm basically showing you exactly how to do it and what I'm doing. Same thing's true with the SPX. You get all the same stuff. You get all the same stuff. This is for things that are expiring in 30 days. This is things that are expiring in 5 to 7 days. The other thing is I just wrote an article for Trader World. If you want to, as a free member, all you have to do is come in here, put your name and email, and you will get this was the latest copy of Trader World. I've got an article in there about trading the SPX weekly. And then we've got some examples of the trading session reviews. This is what I do every night. This tells you what I'm doing every night. Gives you an idea of, I'm putting everything out there. This is an example of the live webinars that you'll receive, okay? And then of course, we've got some testimonials down there. And so there you go. That's my offering to you today. Become a free member. Learn more about this. Learn more about Macro MACD and the regression channel and Fibonacci's and measured moves, and learn more about credit spreads. And I look forward to having you all as potential members down the road.